Hey everyone, it's Daniel here from Infravest. It's been quite some time since I have uploaded a video, but might as well do it now. Hope to get back in the swing of things starting today or tomorrow. But anyways, quite of interesting stuffs have happened since my last post and until now. So let's catch up. Let's catch up and let's talk about the couple of developments. Let's go back, starting with, I did post a video about the Jackson Hole event back in August, end of August. I think the date was August 29th, either 26th or 29th. I don't remember correctly. But since that event, Jerome Powell came out, discussed about his views and the committee's views on where they see interest rates going, where they see inflation, and how they want to continue to fight inflation, and they will do everything that they can to bring this inflation down. Now, the biggest thing that one should realize is the fact that Jerome Powell came out and said, bringing inflation down will bring some unfortunate cost, and that unfortunate cost is pain to households and businesses. The fact that he said that, right? The fact that he came out and said that that's the unfortunate cost and pain that's going to bring that is going to bring for households and businesses is basically saying they want growth and they want to see the economy basically kind of suffer, right? AKA recession. So if you have it from the Fed himself coming out and saying these words, right, warning that they're purposely going to dampen growth, bring growth lower, they want to see the unemployment rate rise. They're obviously telling you that they don't want to see growth, and in this kind of environment where we're in right now, definitely is worrisome for the markets down the road and the economy. Now, I already talked about this in my previous video, but you can watch that on more details. I go more in depth about the press conference, and I read through key points there, so you can watch that video. Now, after that, we had CPI. Now, this was pretty interesting. So CPI, the U.S. inflation metric that came out, and U.S. inflation metric, basically, the markets, if you looked at the S&P 500 and NASDAQ, they were basically moving up. And they were going up in anticipation that the CPI report was going to be weak. They were expecting it was going to be weak. And why were they expecting that? Is because you see commodity prices like oil and other commodity prices like even lumber and whatnot, they have been coming down. Those prices have been coming down. So they were expecting, especially because of oil and crude oil and gasoline prices coming down, they were expecting that at least the CPI report would be soft. And that's why we had a rally in the S&P 500 and NASDAQ until the report came out. And then if you see, once the report came out and they showed that, no, we did not get a weak soft CPI. We got a stronger than expected CPI. Right, all of a sudden, boom, you had selling in the equity markets, and ever since that day, the markets have been dipping, and don't be surprised if we now can get to a new low for the year, right? So it's definitely doable, definitely can see that happening. But since that CPI report, the market started to price in that, yes, 100%. And a week after, we got the FOMC meeting. We've got the interest rate decision a week after. We got the dot plot, the charts and projections that they had, economic projections that they released. That came after a week. But the markets after the CPI report were pricing in that, the Fed's probably going to do 100% for sure do a 75 basis point, and some market participants were believing that they might do 100 basis point. Now, a week later, they didn't do a 100 basis point rate hike. They came out and they did a 75 basis point rate hike. And what caused the markets to sell off initially on that move was the dot plot, and most importantly, the charts and the projections that they had from their rate hike decision, right? Their expectation of rate hikes down the road for this year and next year. So they basically came out, updated the numbers, expecting that growth was going to fall, unemployment was going to increase, and inflation still slightly higher, coming down but slightly higher, and by the end of the year, and that we're going to get about this year 4.4% in interest rates and almost close to 5% by next year. And that caused markets to basically sell off right away when that number came out and those reports came out. And markets were just selling until we got the press conference. And then in the press conference, we had a short covering rally. Markets started to go up. And then, the Fed mentioned that, the markets perceived this, I guess, somewhat dovish when the Fed came out and said that, the pace that they're going at, eventually it's going to slow down. And that caught the markets, that caught a bid in the markets. Now, right away, after a while, the markets did sell off, and that rally was short-lived, which was expected, because even if you slow down the rate hikes, right, let's say November, markets are pricing in a 75 basis point rate hike. Now we want to see what the data comes out for October and November in terms of inflation. Will we see it come off? I mean, if it doesn't, then oh my gosh, you're going to see some pain to come in the markets, really ugly pain, especially when it comes to rate hikes, if inflation is not leveling and not coming off from its current levels. But we still got some more data to look at, which markets are pricing 75 basis points rate hike in November, and then 50 basis point in December. Now, obviously, that can all change, and the projections that they have in September can definitely change. What they put in the dot plot can definitely change. But there's an expectation that they're going to fight inflation. They want to bring this growth down and demand down to basically cause inflation to come off. So when I read that, and when I see the dot plot, and when I see all that information, it signals to me recession. I mean, the fact that, and obviously the Fed's not going to come out and say that, hey guys, we're going to try to engineer a recession. No, you can see it from the projections there that they have anticipated for 2022, 2023, for growth in GDP to come down, and for rates to continue to move up, and unemployment rate to also move up. Now, obviously, they didn't spike those numbers too heavily, the unemployment rate numbers, but it wouldn't be surprising to see that number spike up, especially if we get into a very ugly recession. Now, on top of that, you have the US dollar that continues to rally, right? You hear that the yen completely plunging, the British pound completely plunging, issues in Europe, in Germany, the yield curve inverting in Germany, which hasn't happened. I mean, it did invert a little in 2008, but we're talking about a deep inversion that hasn't happened in history. And Germany is the rock of Europe. It generally doesn't sell off. It generally doesn't come off, and it generally you don't see Europe you don't see Germany posting weak numbers, posting that the yield curve inverting deeply, because again, it's the rock, it's the one that keeps Europe alive. And the fact that their rock, their nation that all of Europe really depends on, is in that when you look at the 30 to 5-year yield curve, is in inverted territory, and heavy, deep inverted territory. This rings signals and bells of 2008, and actually worse, because you're below the 2008 inverted levels. And back in 2008, when there was this the housing crisis, and of course oil was elevated, inflation was a problem, and the ECB was coming out and basically talking about that that they're more worried about inflation, more worried about oil, and not really talking about the risks of that were happening in terms of the housing and the MBS, the mortgage-backed securities, and how that was a big risk that's coming from America, and which eventually affected everyone globally, right? It rings the same bell, rings the same tone, the same song, whatever you want to call it, just like in 2008. And we're seeing it today, where that curve is inverted, oil is still elevated around 70, 80 bucks, and we have a big issue with Russia basically closing the taps on natural gas, and an energy crisis, and you have inflation crisis, and inflation's not coming off anytime soon, and that growth and demand is being affected. Yields in Europe are just skyrocketing. Yields in the UK are skyrocketing, and you have their currency completely plunging while the US dollar is moving up. These are all signals that tell me that, again, rings a bell back in 2008, that these are levels that we haven't seen since 2008, and for the dollar, since the dollar index, since 2000 and 2002, heights and levels that just puts out a red flag. That looks like something, I don't know what is, but something looks like it's going to break very, very soon. Maybe a month from now, maybe 2 months from now. I give it maybe tops February of next year, March of next year. Or maybe not, maybe I'm wrong, right? This is not financial advice, or this is not advice on what to do, but my ideas and predictions on, where all of these fiascos, all of these news that's coming out, whether it's the yen, whether it's the British pound just completely selling off and collapsing, having that liquidation event, right? Just a flash crash all of a sudden. And then you had the BOJ intervening, right? And then Bank of England also, their markets are projecting that they would also intervene and do something, maybe a 200, 300 basis point rate hike. I mean, these are all signals, warning signals. And especially, the UK, Europe, Germany, Italy, and all these nations are in much, much, much deeper problems, just because they're so dependent on Russian oil, and things could exacerbate and get even worse, right? And globally, central banks just continue raising rates. I wouldn't even be surprised if, let's say, if nothing breaks until January, February, and growth data is still somewhat solid or still doing okay, I wouldn't be surprised if we start pricing in 5% or higher in interest rates to try to tame the inflation. So again, things could exacerbate. Again, I don't know what. I really don't know what's going to break. But Europe and the UK, Japan, these are big nations. And definitely they influence everyone globally. Right? And Japan's bond market is huge. And definitely that will have a big influence on all the money markets around the world. Especially European money markets. You got the UK money markets and so on. Right? Of course, United States being the biggest one. China also. But with the United States, having their yield curve also in super deep inverted levels is also another signal that something doesn't seem right. And the US dollar that continues to go up against all basket of currencies, while the other currencies are going against the US dollar, going towards parity or below, or even more into lower levels. Definitely it's going to put a lot of pain for a lot of countries. And what does a lower currency do for a country? It makes it cheaper for foreigners to come in and buy things up, which again creates inflation. Now, higher US dollar, kind of fights inflation. So, other countries out there, if they're trying to buy things in US dollar, it's going to be tough for them because it is more expensive. But for Americans to go to Europe and eventually very soon with the pound, you're going to see it is going to be cheap for them to come and purchase certain goods there, which is inflationary and doesn't solve the problem. So, I've said this before, and I got a lot of heat from saying this also, but I'll say it again, and I truly believe it. Yes, I agree that and again, I don't know, especially with the supply chain issues and with this war, definitely I 100% agree monetary policy, fiscal policy, raising rates is not going to do anything in terms of the supply chain or Putin stopping war and for oil prices to come down. Raising rates is not going to bring oil prices down. However, if you can engineer a demand shock or engineer a complete ugly recession, which many of the global central banks are trying to do right now, all the central banks around the world, Bank of Canada, Federal Reserve, Bank of Japan, ECB, raising rates like, they've never done before, Bank of England, all going out there aggressively raising rates to try to engineer this recession, and not just any kind of recession, but something that does affect and shock the demand side because they have no control on the supply side, then sure, you can bring inflation down. I do believe that. I do believe that if you have a demand shock and you have an ugly recession and you keep rates, you increase rates, and let's say you push rates to 5% or higher and you keep it elevated there for a long period of time, which the Fed has in mind. And the Fed, also Kashkari, came out today and said that we're not going to make the mistake that we made before by cutting rates too early when the economy is weakening. That was a crazy comment today that was said, that we're going to not cut rates early when the economy is weakening. We're not going to make that mistake again. That's pretty shocking. That's pretty hawkish, right? So, I wouldn't, what I'm trying to say is I wouldn't be shocked that if we do, and the central banks do engineer a ugly recession, a very deep recession, then sure, I do believe that inflation can drop and maybe hit below their 2% level for some time. And you can see that from data in previous recessions. When you did have those ugly recessions, inflation has and did in the past come down below their 2% mandate and target. Will it do it this time? I would say yeah. And I got a lot of heat from some people for saying that. So I still hold by those views, and it's just a matter of time till we see. But definitely, it's not looking good. It's definitely something is brewing. I don't know what. I can't pinpoint to you what. It could be in Europe, could be in Japan, could be in China, could be in the US, could be in Canada. I don't know. That just sparks up something and completely blows up. Could be the credit bubble, could be the era of currency being changed into something else, dominance, whatever it is. I don't know what it is, but the signs and the numbers, and when you look at the euro dollars, and when you look at the yield curve and the bond market, and the central banks and the intervention of these central banks, and the fact that, also fiscal policy would eventually, we should see that come off and stop to kind of pump more money. Hopefully that will stop too, because you're still seeing some fiscal policy out there that is keeping printing alive and pumping money in, but eventually probably that will also slow down or stop completely. And with all this hawkishness, and with rates going up, yields going up, mortgage rates in US at 6% plus, eventually demand should shrink. And inflation is not done with too. Let's not forget that. Sure, gasoline prices have come down, but food has gone up. Food prices, shelter, the essentials. You think we're going to stop eating food and buying food and stop living under a roof? No. Unless, you're in a very tough situation, then you can definitely divert and change the way you do things. But you still need to eat. You still need to live in a shelter, in a house or a condo, whatever, right? So, and those I still see going up in prices, because we're still going to buy them regardless of the prices moving up. And the price is going to continue to go up and up and up. And it's a trickle effect, because when you have other nations and other countries out there, and especially the United States being one of the biggest producer of food, when you have other nations that depend on the imports coming in for food or meat or whatever it is, grains, definitely that's going to spark a lot of problems, because there will be more demand for it. And second of all, their currency is weakening against the dollar, and they'll do anything they can to try to maybe convert their currency into dollars so that they can buy food, and they will do anything to get food into their country. So they will the demand will go up, the scarcity or supply will start to shrink. And if the demand is going up for a lot of these countries, then that's going to continue to keep food prices elevated and push prices higher and higher. So overall, it's been a kind of a long video right now. I'm going to stop here. But overall, the point that I'm trying to get through, the message that I'm trying to convey, is it definitely, something feels wrong. Something feels like something is coming up. Something is coming up, and it feels like, something could break very soon. And the severity of the break, more and more, the signs just look like it could be 2008 level you know, recession. It could be, or maybe worse, or maybe slightly better. Again, I can't predict these things, but before I wasn't using those words of 2008 type of recession, which a lot of people were talking about, but I could see that that is a possibility. It could happen. And if not, then definitely, you know, a recession is looking like it is being priced into the markets. The only question is when. When do we break? What's going to break? When's that massive liquidation sell-off going to come in the equity markets? It hasn't come yet. And then we'll determine, you know, how severe it is once it comes. So anyways, good luck everyone. I'll talk to you guys later. Leave a comment below, subscribe, hit the like button. If you have any questions or you have any comments or you'd like to comment on anything I mentioned in this video, again, just leave a comment below and I'll see you guys around. Thanks. Bye.